Welcome back to the channel, everyone. The end is near for the hedge funds, and I think that AMC has a lot more room to run. So today I'm going to explain why. Trust me guys, you do not want to miss this video. So stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 1,600 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, why I think that AMC still has a lot more room to run. I'm going to start with the 2nd of June, the last time we all came in our pants a little. We woke up that day with a low of $35 and we hit a high of $72 in the same day. Not accounting for any naked shorts or shady shares, we were able to calculate around 30 million shares were returned that caused that price action to move upwards. 30 million shares returned caused a 100% boom. It took us about 2 days to see that 30 million number reflected in Ortex. Now I want to take you back to the 2nd of June. Because trades are reported on a T+2 basis, as in they're reported 2 days after they're made, Ortex updated the numbers for the 2nd of June on the 4th of June. Whenever you're looking at Ortex, the data that's happening today actually happened 2 days ago, because obviously funds just report 2 days late. Since then, we've went down and up and down and up. This past week, we've downtrended and bounced off a critical support line of $32. Many apes expected this $30 bounce, even trade called it out before it happened. Looking at the chart on TradingView, this here is where we bounced off that support of $32, which obviously was originally our resistance here that we broke through and it turned into support. At the moment, obviously, we're still somewhere in this downward wedge. I don't really know necessarily where the top area of resistance is going to be. It could be here or could be here. But at the moment, we're obviously trading in this area. We've bounced off the support, so I imagine we're going to start trading now towards the wedge. Around 6.6 million shares were returned after our bounce back from $31 to $39, or $32 to $39. That makes sense. The price was shorted back down, and other shorts used that as a way to get out. A tiny amount of them. Seeing 6.6 million shares returned when there were 101 million out on loan is peanuts. And this is what I was saying in my last video. Obviously, shorts had to short more shares to push this price down. Therefore, yes, some of them managed to cover their shorts here, and that's what caused the price to rise up a little, but they had been adding to their short positions here, so still they're net more shorted than they were back here at the start of June. Yes, the data that's currently been reported to the exchanges shows a significant fall in short interest, down from like 90, 100 million shares to around 75 million shares, but I imagine a lot of those are marked wrong, or not including the failure delivers, or not including the synthetic shorts. But case in point being, supply has outweighed the demand for the last couple of weeks, and that's why the price has moved down. Apes haven't been selling, and therefore that supply hasn't been coming from sell orders. It's been coming from new shorts. There's just simply not another way that supply would be increasing because people aren't selling. We currently see 100 million shares on loan, and we've seen what returning just 30 million shares can do. I do not believe apes are selling. We may have some newer apes showing their paper hands, and that is what it is. Paper-handed punks don't get no tendies, but apes that have been in this stuff since February and understand that this type of volatility comes with the territory, we know that paper handing wouldn't cause this past week of red blood, so I expect to see more shares on loan next week to reflect what happened this previous week. Again, even though this exchange reported short interest has gone down by 10 million shares, the number of shares on loan has gone up. I personally think a lot of hedgies are mismarking their shorts. Previously, we saw 99 million shares on loan with 85 million reported short interest, as in most of the shares on loan were actually shorts. Now, for some reason, the shares on loan has gone up, but the shorts seem to have massively decreased. How coincidental? Especially as the price has been falling non-stop over the past week. How even more coincidental? Nothing good in life comes easy. Nothing worth value is easily obtained. Remember that. You cannot say, I want to be a millionaire and eat tendies, but expect that buying AMC shares will do that for you in a few days. You cannot expect that AMC will just go up and up and up until we're all rich. It will not happen that way, and it will not happen without a fight. So how will it happen, you ask? In my dumb ape opinion, it will happen just like the way we're seeing it play out. The shorts will not roll over and die, they will keep fighting back. They are organised and can break the law with little consequence. They hired psychologists to study how apes will fold under pressure. We need to remember this and stay true to our conviction. But most importantly, we cannot argue with one another. Coming to this subreddit needs to be a place where we can laugh and share due diligence, not argue and point fingers. There's only one finger to point, and only in one direction. That should point towards the hedges, market makers, and their SEC buddies. I will end this with the numbers again. Remember, 30 million shares returned caused a 100% gain. But imagine what 60 million or 90 million can do. Imagine if 60 million shares are returned. What potential margin calls would be triggered on the naked shorts? If you're having a hard time imagining, it will look like a big bucket of KFC tendies, with another bucket inside, with another inside. It'll be a Russian nesting doll of sweet chicken tendy buckets. Stay calm, apes, enjoy the weekend, and I'll see you next week. In addition to that, if we were wrong, they would have covered by now. If we were wrong, they wouldn't have hired thousands of shills and written bot scripts for accounts. If we were wrong, they wouldn't be offering people money to become bots. If we were wrong, they wouldn't be shutting down YouTube investors and sending cease and desist letters to financial investment brokers who speak out against them. If we were wrong, they wouldn't tell us we're wasting our money. If we were wrong, they wouldn't need to continue borrowing shares just to fight us. And finally, if we were wrong, they would have disproven our due diligence and facts. They have yet to disprove it, or why the mother of all short squeezes won't happen. Not a single shred. And it's exactly that. All of these mainstream media outlets are spreading FUD about how the AMC movement is over, but they've never once disproved the mother of all short squeezes or shown how we're incorrect. Because we're not incorrect. The due diligence is there, the research has been done. We know that they can't keep it up forever because they're incurring interest and transaction fees every time they swap around and move around that fails to deliver. We know that they're shorting more and more and more shares because price doesn't just drop for no reason. It's controlled by supply and demand. When demand is high, price goes up. When supply is high, price goes down. At the moment, the selling pressure or the selling supply isn't there because the apes aren't selling. Don't forget, we own at least 80% of the float, if not 90% or 95% of the float, or even higher, and it's not us that's selling. Therefore, the selling pressure is caused by additional new shorts into the market. Even though the exchange reported data is showing that shorts are going down, I imagine it's because they're mismarking shorts or just not recording them, and that's why there's so many failed to delivers that are just getting passed around. Something I think is important to remember is that with the failed to delivers, to get on that threshold securities list, the failed to delivers need to have existed for 5 days. There could be clearinghouses out there that are just passing the parcel or kicking the can with these failed to delivers sooner than 5 days, and that's why they're not being reported on the list. So in fact, there could be way more than 4 or 5 million failed to delivers on a daily basis because they're just being swapped around more often than every 5 days. Guys, be sure to let me know down in the comments below whether you think the end is near for the hedge funds. Also, if you want to pick up some shares in AMC, but you haven't even yet signed up to a trading platform, be sure to check out the links down in the description below. You can currently get 2 free shares worth up to $2,300 with Webull at the moment, with a $5 minimum deposit, and a free share worth up to £200 on free trade if you're in the UK, with only a £1 deposit. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.